What a terrible day today. The market went up like crazy. Look at this jump. Look at this gap. I don't like it when it does that because I don't necessarily have positions that benefit if the market goes up. I've got positions where I would lose money if the market goes up like that in a ridiculous fashion. So I want to talk about or give an update on my Nvidia earnings trade from last Thursday, and then I want to talk about some other trades I made today. So if you recall, on Thursday, May 21st, when Nvidia was trading at around 360, I sold a put credit spread 30 days out, so June 19 expiration, at a 310 short strike and a 305 long strike. I collected $1.03 for this trade. So here's the trade in a different point of view. So on May 21st, I sold the 310 put option. I bought the 305 put option. I collected $1.03 for this trade. So I did one contract, but nothing stops you from doing more than one contract. So by collecting $1.03, basically the capital required for this trade is the difference between both strikes. So 310 minus 305 is $5 minus the premium that I collected, so $1.03. So the capital required for this trade is $3.97 times the number of contracts you do. So I did one contract, so basically it's $397 capital required. So I did this trade when Nvidia was trading at 360, and the idea was that when after earnings there would be a volatility crush in the value of the option premiums, and I can close the trade for less. So Friday was after earnings, but there wasn't much volatility crush, so I wasn't able to close the trade. But today, May 26th, Nvidia was trading at 365, as you could see here. And because it was trading higher and because 2 days have gone by, I was able to close the trade today for 50 cents. So I collected $1.03 and I paid 50 cents to get out of the trade. So there's no more risk anymore. My profit is the difference times the number of contracts I did. So a 53-cent profit times 100, so $53 of profit because I only did one contract. And the commissions will vary with the brokerage that you're with. I'm with Questrade, and in my case, the commission in and out for this trade was about $13. So to win on this trade, I basically need Nvidia to stay above 310 come expiration of June 19. I didn't even have to wait till June 19. I was able to close this trade May 26th. Why? Because Nvidia went up a little bit, and because after earnings there's a volatility crush, so premiums drop in value. So for both of these reasons, I was able to close this trade early, much earlier. I don't have to wait the full 30 days, and I made 50% of my max profit, which is $1.03. So you can see here the executed trade, May 26th, 50 cents. Now I still have an earnings trade on Alibaba. This one's not doing so great. It's not losing money necessarily, but I'm not able to close it, not even close yet. So I collected 94 cents on this trade. And right now, as you can see, I could probably close it for, I could probably close it for a break even, but with commissions, I'd be losing a bit of money. So I'm going to hold on to it a little bit. Alibaba is trading at 202. My short strike is 190. So same idea as Nvidia, same concept. For this trade to win, Alibaba needs to stay above 190 come June 19. But in the meantime, as time goes by, if it's still trading above 190 or if Alibaba is going up, then I can close the trade early. But that's not the case. Alibaba actually dropped after earnings. So that's why I'm still in the trade. I'm not able to close it, but I'm not losing money yet. I have room to the downside. I gave myself room for error. And the room for error basically is from 210 to 190 because Alibaba was trading at 210. When Alibaba was trading at 210 when I placed this trade, and my short strike is 190. So I have 20 points to the downside to make the same amount of money, which is 94 cents per contract. All right, so the other trades I made today, I placed my regular Monday, Wednesday, Friday put spreads on the SPY. Because Monday market was closed, I placed it today, Tuesday. So the next expiration was June 24th. I went with a 285 strike, collected 80 cents per contract in this case. Now I'm sure because the market dropped at the end of the day, I could have collected more if I had waited at the end of the day. So as you can see, I could have collected probably around 84 cents, but I collected 80 cents instead. I placed this trade at the beginning of the day. The other trade I made was I had this call spread at 295 on the SPY expiring this Friday, May 29th. So to hedge against it, I sold a put spread at the same strike, at the same short strike, at 295 as well. So right now it became an iron butterfly because the short strikes are the same. 295 call, 295 put. So now what I really want now is for the SPY on Friday to trade as close as possible to 295, and I'll be super happy. Because if it's trading, let's say at 296 Friday, I can close this trade for $1, and I've collected more premiums than $1 on this trade, so it'd be a profitable trade. If it closes at $2.97, I'd probably close this trade for $2. I'd probably break even on this trade. Doesn't matter. I prefer to break even than to lose money. And I also had a call spread on the SPY for June 8th at a 300 strike. So when the SPY was trading at 302 today, I decided to sell a put spread against it for hedging. And because I still have time, I still have 2 weeks to go, so I sold it at 280. I sold the put spread at 280 and not at 300 like the May 29th one. The May 29th, this I had to get as close as possible because I only have 3 days left. But this one still has 2 weeks to go, June 8th. So I sold it at 280, giving myself some room to win. If the SPY continues to go up, I'll bring this put spread higher. I'll bring it closer to the 300. So maybe 285, 290. I'll gradually bring it higher as if the SPY continues to trade higher. But who knows, maybe the SPY will come back down and it'll fall within this range between 300 and 280, making this trade a winner. So that's what I'm looking for right now with these two positions. But I have 3 put spreads on the SPY. One that I opened today and 2 that I opened last week. So 276 short strike, 279 short strike as well. June 19, June 22nd, June 24th expiration. I also closed a put spread on the SPY that I had. So you can see today I closed the June 17 vertical put or put spread on the SPY at a 277 strike. And I opened it, if we look lower here, June 17, 277. I opened this put spread May 18, collected 79 cents, and I closed it today, May 26th, for 40 cents. So almost 50% profit in about 8 days, while the trade actually had 30 days. So you can see closed P&L today. So the trades that I closed today had a confirmed profit of $92 US. So this 92 comes from the Nvidia earnings trade that I closed today and the SPY put spread that I closed today as well. So if you remember in my RSP, I've got a covered call on IWM, a weekly covered call at a 139 strike. I sold this 139 strike when IWM was trading at 134.6 about last Friday. So as you can see, with one business day or one trading day, IWM jumps from 134 to 138. So this is just not normal. My 1 week strike is at 139. So this is an example of a trade that doesn't go well for me if the market flies like this. Because by selling a call option, it limits my upside potential. And I'm okay doing that because the market isn't supposed to fly like that. It's supposed to go up gradually. All right, so if you have any questions, leave in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use one of my referral codes below to get up to $250 back depending on your deposit, or use the other one to get $50 in free trades. Don't forget to like the video, share with a friend, and subscribe to the channel. Thanks for watching.